I'm Josh Yoskowski.
And I'm Joe Simon. Welcome to the J&J Show, episode 7.
7, I believe. Yes. And we appreciate the feedback, both from clients and prospects alike, of just I'd say, frank, plain discussion between Joe and I that is reflective, and this was welcome to hear, is reflective of the same way we conduct meetings. So we're consistent, if nothing else.
Right. So, getting towards the end of the year here and heading to the fourth quarter. So, Josh, question for you. So, what are some of the things that we think about for clients as we head into the fourth quarter?
Great question. It's probably the best way to address it is this format because there's a number and they're interrelated, but they're also expansive. So some of the more obvious ones, and I'll try to bifurcate these so we can have a nice continuum, is, for example, it's often additive to check your beneficiaries at the end of every year. That is something that I feel, and you may agree or disagree, that you should check at least once a year, particularly if anything changes in your world that should be changed, just because, no one knows what will happen when you leave the house. And that could be beneficiaries on IRA accounts, beneficiaries on employer-sponsored plans, annuities, non-qualified accounts as far as being payable on death or transfer on death. If you have a trust that needs to be listed as a primary contingent beneficiary, these are all things that you should review somewhat in an administrative fashion to make sure they're up to date.
Happens all the time, right? We'll sit down with a client and they think their beneficiaries are, you know, A, B, and C, and they're not that way because they did them 5, 6, 7 years ago. Haven't really addressed it since. So, definitely something I'd recommend as well.
Same thing we see, and it's unfortunate, is sometimes you get smaller accounts that aren't forgotten but are considered perhaps less important to your overall wealth that may have deceased individuals as beneficiaries. And if it's a deceased spouse and say that's the only beneficiary on there, well, that's not going to go the way we want it to go down the line.
We've had clients that, essentially set up an account thinking, well, you know what? I don't know who I want the beneficiary to be right now. Let me get back to you on it. Never do. And then it's been 1 or 2 or 3 years and yeah, hasn't been updated.
Definitely agreed. And that somewhat segues organically to QCDs,
Mhm.
which goes into the idea of beneficiaries, idea of things we talk about at the end of the year, also touches on required minimum distributions. So this really opens up the topic of what are some of the other things we're talking about in Q4. So tying all of those together, the next obvious topics required minimum distributions. So depending on your birth date, you may already be taking them. It may be age 73, it may be age 75. If you're not sure, it's something you probably want to find out, even if that's years off, because there's a lot of planning that can be done between now and when your RMDs may start. And that can be a substantial tax liability if you're not really using those funds. So talking about QCDs, I guess we'll run RMDs and QCDs together. So QCD, qualified charitable distribution, RMD, required minimum distribution, um, eight different ages on them now, which is one of the big points of confusion because the RMD tables have changed quite a few times now as far as the beginning
And
age.
we're really only going to run up against typically 73 and 75, right? So
At this
born,
point in time.
yeah, yeah, because pretty much everybody is aged into the RMD. If you're born before 1960, your RMD will be 73 at this point. If you're born after 1960, it'll be 75.
Yeah. General rule, but always something to ask about because planning very much comes into play with RMDs, whether that's taking or using strategies ahead of time, which is going to talk about QCDs as well, or just what to do once you have RMDs. So let's say we're in the years working up to required minimum distributions right now. QCDs can start at 70 and a half. So this is a case of you can give money directly to a nonprofit organization. It has to be legitimate, not somebody down the street. And there's of course more nuance to it than this, but these are general rules. After 70 and a half, you could donate money from an IRA directly to a charitable organization. And I think a good way to say it is in lieu of if you were making cash donations or donations from a non-retirement account.
70 and a half because it used to line up with the RMD age, but they did not change that with the Secure Act when they changed the RMD age.
Correct. So it can be a powerful tool if you're charitably inclined. It can be a case of it makes more sense to use the qualified charitable distribution than to do kind of the distribution from a non-retirement account because it doesn't count as income against you. It's not going to be taxable as income. So QCDs are very powerful. They often come up with donor advised funds as well. Some people may have both. We often segue out of the DAF into QCDs once we're able. Now, if you have money in a DAF, though, you're still probably going to need.
Still got to use it, but again, once you get to the ability to do the QCD, I mean, I think that's a better mousetrap as far as reducing your tax liability, and you get more money into the hands of the charities that you care about.
Yep, it's one for one on the QCDs. Each dollar doesn't count as income. It can be used to satisfy your RMDs, which is why this comes up in this section, unlike the DAF, which is not going to be a one for one tax deduction or tax credit based on what you donate.
Now, I will note that if you're going to use the QCD to satisfy your RMD, you don't want to wait until December to do it, or even the end of November, because you got to keep in mind that the charity needs to cash the check before the end of the year for it to count as an RMD for that year. And we've seen scenarios where that hasn't happened.
Correct, correct. And then it's trying to make a correction on the distribution or trying to contact a charity. Depending on the size of the charitable organization, some may only have one secretary in an office a few times a month. Check is never found. Okay, we might want to come up with a different strategy for that. If it happens once, it would probably happen again. So we may just want to do QCDs earlier in the year.
So yeah, I would recommend, I mean, no later than probably the end of October, first week in November to do those if you want to make sure that it
Definitely.
happens.
And there are a lot of, and this is kind of a side note, but there are a lot of processing deadlines that come up in December that are not December 31st.
Nope.
Most firms at this point have hard cutoffs in the first week of the month for any number of things, whether that be that, and this is to guarantee processing by year end. That might be for required minimum distributions. Often you need to have them in by the 8th or the 13th in order for them to guarantee processing in that calendar year. Qualified charitable distributions are often a little bit earlier than that because they're not as prevalent. Another topic we'll get into more here in a minute is Roth conversions.
Conversions, usually that's the first week of December.
Yeah.
And the reason being is, well, you may, in your world, you may be the only one doing it, but as far as, for example, an LPL, they may have 30,000 advisors requesting 20 Roth conversions. Yeah, that math adds up pretty quickly.
Yeah, and that's on top of all these going on at the same time. You might have people processing qualified charitable distributions to satisfy an R&D while doing a Roth conversion, small, large, or other, at the same time.
Needless to say, the end of the year is a pretty busy year for firms like LPL and other ones like
Yeah,
it.
across the board. But this is why it's important and why fourth quarter as a topic in itself is so important to us, because come October, that's when we really need to know, okay, what's our timeline for finishing RMDs? If we're doing QCDs, we want to have them out in October, as well as we want to know the full RMD strategy, conversion strategy.
We've had our team spending most of August and early September going through our clients who have RMDs and determining who's on track to meet the RMD for the year and who isn't. And we're at that point now. We're going to start reaching out to those clients that aren't and talk about the different ways that we can distribute the RMD. And Josh, can you talk a little bit about how we might distribute an RMD?
Yes, absolutely. So we talked about qualified charitable distributions, and that's if you're charitably inclined, and not everyone is, and that's fine. It's just one way to do it. So when it comes to your RMD, traditionally people are going to say, oh, I need to take my RMD. And what they mean by that is they're going to sell some securities equal to or above the value of what they need to take for their RMD, because the RMD is a gross number, not a net number. If you're taking a distribution, the tax distribution counts as part of satisfying that RMD.
Clarify gross and net because that comes up with people
Yes,
sometimes.
yes. So gross is the before tax distribution, net is the after tax amount. So, and some people may hear us say this even on the phone of what amount do you need to hit your bank account? That is the net amount. That tells us, okay, we can then do the math to find out what do we need to withhold from a state or federal standpoint from the gross distribution to get you that net number. And I'll always say processing time on that is 3 to 4 days. Unless you want to do a wire, and wires almost everywhere have a fee, and wires take place by the end of the day, but they're not guaranteed to be exactly at the time you do it. So quick sidebar there. But as far as addressing the RMDs, so talking about the difference between gross and net, most people take it as cash. They may or may not know that there are other options. So again, QCD we talked about. Taking it as a cash distribution, that's the most simplistic. Next, we might have, let's say you have a security that you like and that you do not want to liquidate. Well, that security could be transferred to a non-retirement account that is a taxable transaction for the value of that security, which people may already be able to tell at that point because the values of securities change. That means that it might take one or two steps to get that exact value.
And honestly, if I've got a client and they don't really, or they're pretty agnostic about which securities they want to transfer, I'm going to look for a security that has a lot of growth potential, right? Because I'm going to get it out of that tax status where it's fully taxed as income and get it into a non-retirement account where now it's just capital gains and state tax on growth.
And the same thought process for Roth conversions, which we'll come to in a minute. But that means that you don't have to sell the security to satisfy the RMD. If you don't need the money, don't want the money, whatever it happens to be, have a security you like, you want to keep, you'd love to see in a non-retirement account, we can convert that security. We will still have to pay the taxes, which can be done through that transaction, or you could do a 0% tax withholding and pay for that separately, which again is another Roth conversion idea. But transferring securities is another very common one for that. So those aren't all the strategies that exist, but I think those are kind of the three mainstream is, okay, I'm going to transfer securities, I'm going to take it as cash, or I'm going to do a qualified charitable distribution. And all of those have their own processing time. All of them take paperwork. All of them should be a discussion. You can't gift, and I know this sometimes come up. People say, well, can I give some of my IRA money to somebody else or anything like that? That's not really a process that exists unless you're okay realizing the taxes. But that gets into
Well, you also can't gift your IRA money to a foundation, a DAF as well, donor advised fund.
yes, yes. So that's a great point. We've seen this come up, and it can be a little bit confusing. The DAF and I guess the donor advised fund, so money you donate that this donor advised fund then manages on your behalf, but you no longer technically own. That's why you had a tax benefit from it. Those are the means of giving to charity with two different types of tax ramifications or tax types. You have pre-tax dollars as a QCD, the donor advised fund, the charitable non-retirement fund is going to be funded with non-retirement, non-qualified dollars.
Yes.
So if it's a case that you've ever had something happen where that may not have been the case, or in a given year there's a little boo-boo that takes place there, it can typically be fixed or unwound in the year it takes place. If it takes place more than a year ago, then that's a bit of a different story. It might be amended tax filings. It can be some work.
And I bring that up because there has been confusion around this with some of our clients. So we thought it'd be worth pointing out here.
And it's nuanced.
Yeah.
And again, if you know if you're into a strategy and it was represented that it's going to work this way or that way, just need to make sure that we go through the fine details again to make sure it's actually going to go that way, and the way you want it to, and that there's going to be no hiccups, amended filings, anything like that. Since we almost ended up in that position with some other accounts.
While we're on RMDs, Ross, I was thinking about, can I take an RMD out of my IRA for all of my accounts, including my 401k?
Another great topic. Thank you for raising that. So it's an aggregate, depending on the account it's coming from. So if you have a collection of IRAs, traditional IRAs, pre-tax accounts, maybe you have four of them and each of them have a required minimum distribution of $2,500. Okay, 2,500 times four, that's 10,000. You just need to take 10,000 from pre-tax accounts. One of those accounts, in this, my hypothetical, they're all clearly even amounts, but let's say that one of them is smaller than the rest, you could decide just to empty that account out and be done with that one account. Now you only have accounts on, or RMDs on three. So that's a common question of, well, I need to take 5,000 from this account, 7,000 from this account, 8,000 from that account. Well, maybe it might depend on the account type, but if it's IRAs, it's just going to be a circumstance if you can aggregate that. That also goes to the case of, because not every account type lets you do that, such as, and we'll just say it, TSP does not play with partners. If you have an RMD from TSP, you cannot take it from another account. It needs to come from TSP. But the RMD planning, just through this hypothetical, illustrates that there are a lot of different things that could be going on. It may very well make sense, not just for performance or professional management, but just from simplicity of not over distributing RMDs, may make sense to consolidate.
Can I take my spouse's RMD from my IRA?
Cannot.
All right.
And you also can't take future RMDs early. Now, the other place that's been a bit of a hiccup is the first RMD takes place in the calendar year where the individual hits their beginning age, their RMD age. So even if your birthday is on December 30th, and we have, I think, two clients that are like this, you need to take your RMD in that calendar year at any point. You can take an RMD anywhere from January 1st to December 31st. I wouldn't recommend December 31st, needless to say. You can take it anywhere in between there and satisfy that year's. If the first year's is missed, or say you're still working, but the following year you're going to be retired, you can kick the first RMD down the road, but then you got to take two.
You got to take two in that second year, which for tax purposes may not be advisable, right?
It's going to be very situational. I know I can count on one individual we had that happen with because she was retiring at the end of that year and her income was still going to be less taking both the following year.
You can do it any way you want. You can take it monthly, you can take it quarterly, you can take it all in one lump sum in the beginning of the year, the end of the year. It doesn't matter how you take it. It's just you got to get it all done by the end of the year.
Yep, and you can take it in any of those combinations. You could first do, okay, I normally give $5,000. Let's do that as qualified charitable distribution. Okay, I need 10 grand for XYZ. Okay, we'll get you the 10 grand net in order to have that number. And then whatever's left, you may say, well, just transfer that part as securities. So there's no right or wrong way so long as you get done what you need to get done before December 31st.
And then going back to QCDs, one of the things I would stress is if you're going to do a QCD, you got to make sure you keep track of it and let your CPA know that you distribute your RMD as a QCD, because what you're going to get from LPL or whatever firm you do your RMD from, you're going to get a 1099 just like any other, right? So it's important that the CPA recognizes that that distribution was a QCD and reflects that on your tax form appropriately.
Yeah, it's more self-reporting in that respect to your point. What we can provide is always the QCD form that was filled out. That is why it is its own form, so that you effectively have that receipt for your own records. And again, we're talking about QCDs under RMDs, but QCDs can be done anytime 70 and a half up.
70 and a half up, but you are going to get a 1099 that looks like a distribution without a tax withholding, and that's why it's important to let your CPA know. Otherwise, and we've seen this happen, it won't be reflected correctly on your taxes, and you'll end up paying tax on dollars you shouldn't.
Necessarily, yeah. And I think last thing on that administratively is not every firm or provider or company does QCDs in the same way. Some allow you to set them up automatically multiple times a year, maybe monthly. Some have to be done manually each month or manually each year, or you have a limit on how frequently you can do them within a calendar year. Maybe it's just one time. So something to be cognizant of. I can say from our experience, firms prefer to do fewer QCDs as opposed to more. At most, we see some that are okay, that allow them systematically to be done quarterly, but seldom more than that. And most are going to push to have it done one time a year. So again, Q4 is typically when we see that taking place to meet kind of those commitments you may have made. I think that then alludes to, so the three ways to potentially address, or three of the ways to potentially address RMDs when they're potentially here, that we're at the RMD door or we're in RMDs. That alludes to the whole other way to address RMDs, which is ahead of time. Please tune in to our next episode. I think it needs to be 7.5, as it is a bit of a continuation of 7. Just to close out, I'm Josh Joskowski.
I'm Joe Simon. Like,
comment,
and subscribe. We'll see you next time on the J&J Show.